been a scholar. He's been a scholar for the Division of Insurance at the Federal Deposit Insurance Corporation, which we discuss a lot in our conversations. A scholar at the Bank Research Division at the Office of the Comptroller of the Currency Department of the Treasury. A resident scholar at the Jerome Levy Economics Institute in Bard College. And also something that's very interesting to me is on the editorial board of the International Review of Accounting, Banking, and Finance. Phillips also taught at Texas A&M University in College Station, Texas. He has published widely on banking issues, entrepreneurship, and public policy books in academic journals, newspapers, magazines, and public policy briefs. He recently edited a 6-volume series on the history of credit and payments in the US from 1800 to 1935. And I also learned he just recently wrote a book on rock and roll. So Dr. Phillips is going to talk with us for 20 minutes to 30 minutes about the subject matter that he's an expert in. And then we'll just take questions and let the conversation flow from there. So Dr. Phillips, please go ahead.
Okay, thank you very much, Mark. Happy to be here. And what I'm going to do is go through a few comments, and then I hope to have lots of questions. I do, again, appreciate the invitation. Now, the first thing I want to talk about is how I got interested in this whole issue of safe, what I'm calling safe and stable banking. When I moved to Fort Collins, Colorado in 1983, one of my colleagues said, you know, there's an old guy here that you need to go meet. He's in a rest home. It's Lloyd Mintz. And I said, Lloyd Mintz, he's still alive? Lloyd Mintz was one of the founders, the three main founders of the Chicago School of Economics. He was one of the first to come there, in fact. He came there in 1919 from Colorado, where he had received a bachelor's and master's, and they put him to teaching money and banking. So we went over to talk to Lloyd Mintz, and Lloyd Mintz started saying, you know, what the problem is, these bankers don't have such good judgment. And what we really need to do is operate with 100% reserves, keep the bankers from creating money. Now, when Mintz said this, he said, stop the banks from overissue. Remember, he was writing at a time when banks were issuing banknotes, you know, not just checking accounts, but actually issuing banknotes. So he was talking about the overissue of banknotes. So that got me to thinking about, you know, the problem that I'd always had with banking. When you saw this in economics textbooks, they had a thing called the money multiplier. And the money multiplier, you know, somebody puts $100 in the bank holds 10% reserve and then loans out 90. That 90 goes into another bank. So that bank holds 10%. And then that $81 goes into another bank. And I never liked that. And I realized when Mintz told me that about 100% reserves, that was the answer to my money multiplier problem. The money multiplier should be 1 is what is the bottom line. Now, so I started working on this topic, and I published some articles and you know, some academic articles and things. But then in 1992, I was able to go to a Jerome Levy Economics Institute, which is at Bard College in Endell and Hudson, New York. A senior scholar there was Hy Minsky. And I'm sure some of you have probably heard the name Minsky. His name always comes around when there's financial crisis. So he's been popular really since 2008. Unfortunately, he died in 1996. But Minsky was a undergraduate student at the University of Chicago, and he studied under the three three leaders of the Chicago School. And the primary one was Henry Simons. Henry Simons was a large influence on Minsky. There was then, of course, Lloyd Mintz, and the last one was Frank Knight. Those were the three individuals that formulated the original Chicago School of Economics. Minsky really took off from there, and I can talk more about Minsky later, answer any questions, but I was fortunate to have an office next to him for 2.5 years. Minsky developed the financial instability hypothesis, and like I say, he's done a lot of work, and there are many more things to say about Minsky. Well, this culminated in 1995 in my book, The Chicago Plan and New Deal Banking Reform. And what I discovered is this Chicago Plan played an important role during the New Deal period. It was important because it was an alternative to what we ended up with, which was federal deposit insurance. If we had had the Chicago Plan, we wouldn't have needed federal deposit insurance. Things would have been quite different in terms of the evolution of the financial system. Okay, so that's how I got into this. Now, what is the Chicago Plan? Well, first of all, what do banks do? What are the fundamental activities that banks engage in, the fundamental functions? Two things. They make loans. Yes, we know banks, you can get a loan from the bank. And then they issue a convenient means of payment, your checking account or debit card these days. So those are the two functions. Those functions are credit, that's the lending, and the payment system function. Now, the question becomes, should banks be doing both of those functions? Should they be taking your money and then lending it out? Answer of the Chicago Plan is no, they shouldn't be doing that, okay? Now, this then leads into a few other things. Once we understand this credit and payments, two separate activities, and they could be under separate firms, we have to think about, financial crises. What are financial crises? Well, again, financial crises can be either in the credit system or the payment system. Now, if it's a payment system problem, that's referred to as an illiquidity problem. So you hear the terms liquidity and illiquidity. All that means is you've got something that you can't convert to money that you can make a means of payment. In the 1930s, what it meant is your bank went out of business and your checking account, you couldn't write checks on it. Okay, that's a problem of liquidity. Now, the second problem is on the credit side is a problem of solvency and insolvency. If your assets are less than your liabilities would be loans and so on, then you are insolvent. Assets less than liabilities mean you're insolvent. That's a problem on the credit side. So these two things, though, especially if you look at the 1930s and if you look at the 2008, these things get kind of mixed up and confused and stuff. But there's still two separate problems. One is a payments problem, liquidity and illiquidity. The other is a credit problem, solvency and insolvency. Now, in our mixed economy, we know that there's both a role for the government sector and the private sector in these types of financial crises. Now, here's what I would say. If it's, and I'll give examples of this, but if it's a problem in the payment system, liquidity and becomes illiquidity, that is a proper role for the Federal Reserve. That's where the Federal Reserve should be involved. Now, if it's a problem with insolvency, meaning liabilities exceed assets, that's a problem that for the government sector that the US Treasury can deal with. Now, again, we can talk about this, it gets real confusing about what the Treasury does and what the Federal Reserve does. The Federal Reserve should be primarily concerned about the payment system, liquidity and illiquidity. The Treasury, US Treasury, should be concerned about solvency and insolvency. And if you look, again, the example for today, what does the Federal Deposit Insurance do when they come in and take over a bank? They inject capital into it. In other words, the FDIC deals with the insolvency problem. And that's a proper role for the FDIC, okay? And they get, well, we can talk more about, if you have questions about the FDIC, but that's an entirely proper role. What we don't want is, what we unfortunately have often, is the Federal Reserve ends up bailing out insolvent firms. And that happened in the late 1980s, it happened in 2008, it's of course happened in the 30s. And so it's been a continual problem. Now, however, in US history, we have done some things right about dealing with these problems. The first example I want to talk about is in US history is the National Banking Act of 1864. Now, the National Banking Act, the problem you had in the 1860s, or one of the problems in the financial system, is you had no national currency. So you had thousands of banks throughout the country all issuing money. Every bank could issue their own banknotes. What the National Banking Act was intended to do was to create a uniform currency throughout the entire country, one that can be redeemed at its par value, or its face value. In other words, a $5 note would be good for $5 in buying goods and services, whether you were in New York or San Francisco. Okay, so that was the purpose of the National Banking Act. Now, how did they make this national banking system work? They required that the national banks that were, again, chartered by the Office of the Comptroller of the Currency, which was created for this, the national banks had to hold 110% in value in government securities against the value of the banknotes. So they could issue $100 in banknotes if they had $110 worth of government securities, okay? So that was the requirement. Now, what does that mean? Well, the government securities were safe assets. And that meant that throughout the country, that a $5, a national banknote in New York, you could spend it in Texas and it would still be worth $5. So that was a very important development. What happened to the national banking system? Well, very simply, the national debt basically disappeared. We didn't have any government debt at a period of time in the early part of the 20th century. And so the national banknotes sort of failed. Plus, this was also the time that private banks started their checking accounts as an alternative to banknotes. So again, we had a long period in the 19th century when banks issued banknotes, just $5, redeemable at such and such bank. Okay. After the national banking system was established, these banks started offering checking accounts. And of course, that again changes the whole game. Where things really, of course, fell apart was the Panic of 1907. And then that led ultimately to the Federal Reserve. Now, the Federal Reserve was kind of a mess because we didn't have a lot of government securities. And the Federal Reserve was issuing banknotes against commercial paper, which is just short-term loans to business, and gold. Well, the Federal Reserve was a failure to try to stop the Great Depression. All right, it didn't work. What they did do, really beginning in 1935, is they began to authorize the issuing of Federal Reserve notes against holdings of government securities. If you look at the balance sheet of the Federal Reserve from 1935 to 2008, you'll see that for every $100 in Federal Reserve notes issued by the Federal Reserve banks, there's like $95 in government securities held. So that, again, that's safe banking. So the Federal Reserve System was working just fine, up to 2008. Now, again, we can talk about, what happens after that. Now, the other thing that people forget about, so that was sort of the safe banking liquidity problems. The other thing that people forget about in the 1930s was the role of the government, the Treasury, in lending. And that was done through the Reconstruction Finance Corporation. The Reconstruction Finance Corporation was a continuation of the War Finance Corporation, which was begun in World War I. The Reconstruction Finance Corporation made government loans to business. And those government loans were, on the budget. They were on budget. The Treasury allocated, turns out it was like $50 billion to make loans to business. The Reconstruction Finance Corporation started in 1932, but it operated through World War II. If you wonder how those factories, how General Motors and all those converted to building tanks, It's because they got loans from the Reconstruction Finance Corporation. So again, that's government credit to business, and it worked. There's a book, I don't know if you can see this, but this is, well, I'm not sure it's showing up here. Here it is, $50 billion. This is Jesse Jones, who was a banker from Texas who ran the Reconstruction Finance Corporation. This is the model on how government should make loans to the private sector. And it's still valid today. We've used some of that and forgotten some of that, okay? So that's what we've done in terms of history. Now, there are a lot of things, I think, you know, they come up these days that I think people probably want to ask about, and I'll throw out a few things, and then you can ask whatever questions you want. But in terms of like history, people talk about the role of the goldsmiths. Well, there's that history needs to be corrected somewhat. It's not just that the goldsmiths could loan money just whenever they wanted, because they had to hold warehouse receipts in gold. You also had in the United States prior to the 1930s, postal savings banks. Those were a great idea. Bankers didn't like them. And in recent years, you've had this modern money theory or modern monetary theory, at which Randy Ray was one of my colleagues there at Levy for quite a while. It was the early developer of this, and you know others have gone on to write about this. Now, this is related to these ideas, but you've got to get very clear about what does the Federal Reserve do and what does the Treasury do, and how they work together. One other thing, and then I'll open this up for questions, and that is in the 1980s, late 1980s, this guy Bob Lighton had a proposal for what he called narrow banks. And narrow banks basically applies the principle of the National Banking Act to checking accounts. So narrow banks would be against demand deposits, checking accounts, banks would have to hold 100% in US government securities. Now, this is an idea that is still around. It's in various forms, various people have talked about it. Another idea that's been floated would be having accounts basically at the Federal Reserve banks for individuals, okay? Now, you could do this either through just, you know, instead of opening your account at First National Bank, open your account at the Federal Reserve Bank of Kansas City, for example. Morgan Ricks is a guy who has proposed this. And it's also an idea that's related to the central bank digital currency, because again, if you could have an account at the Fed, that's going to be totally safe. Of course, the bank, it's not going to be making loans. And of course, the bankers aren't really going to like that because of unfair competition. Well, I think with that, I've got a few other things, but I think I'll stop and see what questions people might have.
Thanks, Dr. Phillips. Appreciate your short talk on that. I do have one question. Maybe you could elaborate on a little bit, since you are the Alliance for Just Money, and that's your feeling on one of our goals, which is obviously sovereign money, and the government issuing money without debt for public purpose. Do you have any comment on that? I think that may spark some interest also.
Yeah, here's the deal. Henry Simons was the main formulator of the Chicago Plan. And Henry Simons had this idea of what the financial goods society would be like. And here's his description of financial goods society. Money would be only one thing would be money, and that would be fiat currency, or just, again, currency issued by the Treasury, okay? And the Treasury would take those dollars and spend them on goods and services. So Henry Simons' idea is the only thing that's money is the government created money, okay? Now, banks could not create money. What could banks do? Banks could either issue equity, or what amounts to the same thing, infinite maturity bonds. If you think about infinite maturity bonds, that's basically the same thing as stock equity, you know, because it always redeems at the current market rate. So Henry Simons thought the simplest and best idea that everybody could understand is if you had only the government create money. Now, he wanted the government to do that at a certain rate. So he's going to make monetary policy and fiscal policy the same thing, basically. So the government's he had a proposal to fix it, the rate of growth of money, government money at a certain rate. That would also fix government spending. So it sort of solves two problems at one time. Now, Milton Friedman picked up on some of this, but he didn't carry out the whole thing. But that is an idea, that's sovereign money. And Simons, who was an advocate of laissez-faire for every industry except money. Money was to be a government monopoly, and that's consistent with, was it Article 8 of the Constitution, that Congress has the right to coin money and protect the value thereof. That's what Simons believed. Okay.
Okay. Well, I think that's a great answer, at least from my standpoint, anyway.
Yeah, it is. But again, he's talking about the financial good society. People get real confused now about the Treasury money because the Treasury issues coins, and they used to issue currency. Now, you know, it gets confusing. But Simons was trying to say, here's what, if we really would, you know, straighten things out, we would have money and basically equity, and that's it. No short-term debt, nothing else. No near monies, nothing else. So
I'm going to follow up on that question
okay.
on the international accounting scene a little later, but right now, Paul LeBeau has his hand raised up. So Paul, go ahead.
Okay.
Hey, Ronnie, thank you so much for
sure.
accepting the invitation. I read this book, and it was fascinating just to see how Simons and Fisher and the other economists at the time really wrestled with this, and
yes,
the pushback they got, and how, because it kind of informs us what lies ahead. Because even back then, you had major economists that really were for this switch in the banking system. Now we don't have that, so we're even further behind.
Yeah, there are still people. I mean, Morgan Ricks is kind of an economist lawyer. You know, there's some others, like I say, Bob Lighton, but Lawrence Kotlikoff. You know, there are people who talk about these ideas. But the thing that was unique in the 1930s, and then you sort of realize, you know, man, what a great opportunity. You had Lachlan Curry, who was the first PhD economist to be an advisor to a president. He was special assistant to Roosevelt. Lachlan Curry was in favor and wrote a lot on the 100% reserve plan. You had, you know, and so you had Adolph Burley, who was part of the Brain Trust. He was in favor. Rexford Tugwell, and again, another part of the Brain Trust, in favor of it. You had Henry Wallace, who was the Secretary of Agriculture and then became Roosevelt's vice president. He was in favor of it. All of these were in favor of it. But, you know, so I don't know if I guess you can read the book to find out the story, but the story ends up being basically a political story, not surprising in terms of, you know, how things end up getting passed. And I would say, to sum it up, basically the bankers were threatened with, if you don't go along with things like federal deposit insurance and reforms of the Federal Reserve, then we're going to impose 100% reserves on you. So it was kind of used as a scare tactic for the bankers. That's right. Basically the way I see it. Right. And even though, you know, like I say, many economists advocated it would have been a much better solution. And that includes people like Irving Fisher, who again, one of the biggest names of 20th century economists. They all favored this, and they had good arguments. They had all, you know, pros and cons. And Henry Simons wrestled with a lot with people about this. So if it could have been done, that 1930s was the time to do it. These days, however, I would say if you look at some of the things that they're developing in the payment system, you've got PayPal, you got Apple Pay. The private sector is doing a lot of the payment system, and that can work pretty well and be pretty efficient. And there still be a role for the Federal Reserve in that. Again, what I'm concerned about now is the Federal Reserve is basically, making bad loans, and that's problematic.
So you kind of made my point in that really the 1930s, the economists don't exist anymore, so it's a whole different ballgame. But let me have a question. Yeah. We often claim that if the government creates money, as you say, is the only creator of money, and if the only money that can be lent is money that's savers decide to put at risk for banks to lend, is that sustainable?
Well,
are there any studies?
But see, here's the thing. The money, that's where you got to keep this separation of payments and credit in mind. The money for payments, that's not going to be loaned. In the pure 100% Chicago plan, that money is not going to be loaned. Any lending, you could think of it as like mutual fund banks or credit companies, whatever you want. Right. It's not going to be money. You could have that. And you could also have the government through something like a revived Reconstruction Finance Corporation make loans to the private sector. That's not money. You got to keep those. You got to keep the money and the credit separate. So you got to be careful about saying, when you say loan money, you're lending some of your net wealth, some of your capital, but we don't want. And I would say this, I'm perfectly happy to have the federal government make loans, but I would like to do it through an explicit thing like the Reconstruction Finance Corporation through the Treasury, where Congress allocates a certain amount of money and it is put to use to build infrastructure. And I think there actually may be some of that in the new infrastructure bill. I haven't had a chance to check everything out, but when the government can do that, that's fine. This is also where a lot of the confusion on modern money theory comes into play as well. But
okay, I have more, but there's others.
Okay.
So.
Do we have any other questions lined up right now? Please.
Am I unmuted?
Mr. Dotson, I believe. Is that it?
Okay.
Yes. You said in your view banks should not make loans, and I there's a couple of things I have to comment. I'm a retired banker and I made loans for my living, but these days a majority of the loans that banks are making are secured loans by real estate, and people I know like Mike Hudson and some other economists argue that it's too much risk in the economy for so much money be going into real estate. However, a lot of that lending is transferred to the secondary market. So right now you have Fannie Mae and Freddie Mac picking up the majority of it, and there are other secondary market investors that can handle the duration risk much better than banks that are trying to match duration with deposits and short-term loans to commercial entities. So, given the reality that not a whole lot of banks are portfolio lending, then what would be your objections to continuing to allow commercial banks to do that?
Well, you got a couple answers for this. One, I would note that under the original National Banking Act, those banks were prohibited from making real estate loans. Okay, absolutely prohibited. Now, the second thing is, I actually don't have a problem with federal deposit insurance in the way small banks are making commercial loans. What I've said is, at this point in my life, I would be happy if you could revoke the bank charters of the 10 largest banks, because the big banks don't use deposit insurance, insured deposits to make loans. They do all this other stuff and gambling. The only reason the big banks have deposit insurance is when they fail, they want to get bailed out. So you know, my minimum reform would be to revoke the bank charters of the 10 largest banks. If you could do that, you could go a long ways toward helping our financial system. Small commercial banks, you know, loaning in communities and so on, they know their communities. I don't really have a problem with that. So when I say, you know, keep banks, you know, this Chicago plan was one put forward, yeah, for all banks. But as a practical matter, it boils down to, do you really want deposit insurance for these very large financial institutions? And I would say no. For small banks, you know, it's worked out actually pretty well. And if a small bank fails, it's not a huge loss to the FDIC insurance fund because you inject the capital. Yeah.
I just have a brief follow-up, and that is, it seems to me that what we really then need to do a lot of what you're suggesting is we need Glass-Steagall to be put back into play.
Yeah, and in fact, and I talk about that in my book, not only what Glass-Steagall really should have done, and if it had been completed, it would have separated the basically commercial and investment banking completely. In other words, separate the deposit function from the credit function. You know, you have to, you know, remember, you know, who wanted that separation of commercial and investment banks? Well, you know, it's a matter of who's. If you separate the commercial investment banking, you've just eliminated competition for the investment banks, and in terms of you know what banks in the 1930s and before were you know buying all sorts of securities and everything like that. So you really wanted to, you know, Glass-Steagall bring back Glass-Steagall, but I'd go even further with Glass-Steagall, and that's to separate those depository and lending functions, or you can just put it as totally separate commercial and investment banking. That was a big mistake. But so happen to know one of the guys, Phil Graham, was a senator, an economist from Texas A&M, and also a senator from Texas, and he was one of the ones behind that, and it was a bad idea.
Thanks. We got a question from Matthew Sparks, and then we'll go to I want to say Constantine, and then back to Paul again. Go ahead, Matthew.
Okay. Yeah.
Hi. I'm a little new to this, and I'm a little confused.
Okay.
So let me see if I can paraphrase what you're saying. Is that to get a loan, like for a home or a small business, or even if I was GM, I would go to my local federal bank, and they would either thumbs up or thumbs down on my loan?
No.
Okay.
No, we don't want the Federal Reserve banks to make loans.
No, I get the Federal Reserve. No, okay. I mean the money creation. Where would I get the money that's available to be lent? You would get it from you know, any private firm that is willing, any person firm is willing to make the loan. So it's somebody that has to have basically positive net wealth. 100%.
And how they, you know, they're holding assets greater than security, so they have some positive net wealth. Now, how they're holding that net wealth might be in a bank, it might be in cash, it might be in, you know, whatever. They could make that loan. It's what in economics it's called direct finance. This firm will make a loan to another firm or another individual. So it's not a matter of, you know, the money is again for means of payment, and right. that's not really an issue. You know, you've got to. That's one of the most confusing things about all of this. You've got to keep the lending, the credit separate from payments. Payments is just, you know, writing a check for goods and services, or you know, whatever it might be. Somebody that gives you a loan, they can write you a check, okay? But what they're doing there is they're giving you part of their net wealth.
Right.
Okay.
One follow-up. So if I understand you correctly, I get a loan from this private bank or whatever you're talking about, and I don't pay my debt Okay, it's coming out of his pocket, and
he loses.
Illiquidity problem is not the problem.
Right.
I gotcha. Okay.
Not paying your loan is insolvency. That
right.
causes
not
illiquidity.
Illiquidity. Yeah.
Yeah. Liquidity is just when you can't convert something quickly into cash. And that's usually very, very liquid assets, you know, government securities or whatever it happens to be. Or like I say, in the 1930s, you know, you couldn't go to the bank and get cash. That's a liquidity problem. You know, what did Roosevelt, Roosevelt closed the banks for, I think, like a week. What did they do in that week? What they did in that 1 week is they ran the printing press and they printed up lots of paper currency, and they basically then made, through the Federal Reserve, they made available discount loans to all the commercial banks, saying, if there is a run on your bank, then you're going to have the cash. Now, you say, well, how could they do that? Well, that's a pretty gambling thing, basically. And of course, what happened is Roosevelt was so convincing that there weren't runs on the banks. Okay, they were prepared to experience runs on the banks. And if they had, the whole, is it illiquidity or insolvency? Who knows? But Roosevelt basically, and that's really the amazing thing. If you ever listen, you can listen to those fireside chats. Roosevelt explained about banking, and people believed him, in 1933, and they didn't run on the banks after Roosevelt spoke. So I don't know if we have that much confidence in politicians these days, but it worked in 1933.
It's doubtful. Go ahead, Leo.
Hey, so I'm just trying to get back to what I think is the focus, is that for me, I see that it's very problematic that private for-profit banks create the majority of money in circulation with their lending practice. And I posted right at the beginning of the chat that there is zero reserve ratio. The federal bank, as long as they make their intraday bank settlements in, the money that's not in public circulation, then they're fine, no matter how inflated their books are. And the real imperative here is that, to me, it seems that these private for-profit banks, when they create money via their lending practice, they select recipients who fit their growth imperative, their profit imperative. Mm-hmm. And so we're kind of all here because we're trying to bring this, what seems like a very public service, the creation of money, back into the public domain.
That's right.
Of our sovereign bank. And so to me, the federal government's imperative is the social well-being of the nation.
Yeah.
And so when they were selecting things to fund, when they were creating money, because as is their constitutional right, hopefully they would select things like healthcare, education, a Green New Deal, infrastructure, instead of delegating that to a private money-creating entity with a high profit margin. And I'm almost done. We can take from the MMT people that will use taxes to, keep inflation in check. And we won't overheat the economy, as long as there's capacity for good to be done, we can keep creating money, so you don't oversaturate. And so to me, I've been following Stephen Keen a lot, who's a great monetary thinker.
Yeah.
And, he basically is like, we're not going to get this. Like, there's fat chance we're going to get this. And the reality is that market-based economies, maybe 10 years ago, would have been up to the task of the climate issue. The IPCC report came out today. Revenue neutral, carbon fee and dividend 10 years ago might have gotten us on track. And, this is his perspective, but I also pick it up and say that, we're going to wait until things get sufficiently bad. And then we're going to be faced with more of like a command economy, like a wartime economy, where people start to accept rationing. And this is getting pretty far outside the discussion, but we're going to have to do this piecemeal. I don't see our American political system being able to say, we're going to do a debt jubilee. We're going to give all Americans $100,000. They're either going to have to pay down debt to remove the private money from circulation, debt-based money, and anybody who doesn't have debt will have to buy, I don't know, new corporate shares. That way, there's no moral hazard in this debt jubilee. Or, you know, we're going to create personal saving, or like a digital equivalent to cash, and we're going to give every citizen an account, and then we're going to slowly drop down the insurance on private debt-based money so that, you know, there isn't a run on the banks, but over time we can move into public money. So I'm interested in what you think are viable first steps in that process.
Well, you know, it's a tough thing. Let me see. Like I said, I would be happy if we could get the 10 largest banks, revoke their bank charters, get rid of them as banks. Okay, that's kind of my sort of minimum.
Is their bank charter their license to operate?
Yes, but it's their license to get bailed out by the Treasury, which is the the big problem.
Okay. Yeah.
But I'm totally in favor of the federal government investing in climate change, all these other issues, infrastructure and everything else. And we need to do that through the Treasury. And I'm not worried about, you know, if it does it through borrowing, that's fine. You know, what MMT says, the modern money theory is that, you know, you can basically sort of, you know, print the money. And I mean, things get complicated when you start looking, you know, if you just collapse the Fed and the Treasury balance sheets, you know, you can basically just sort of print the money. And they say do that until there's inflation. Now, again, let me go back to Henry Simons. What he said was the financial good society. This is the ideal world. Only the federal government could create money, and it would create that money and go out and spend on whatever goods and services that, you know, people wanted the government to spend on. Okay. And that would be great. There wouldn't be any bank creation of money, any private bank creation of money whatsoever. So commercial banks, they could still make loans, but they would be doing it with their own equity. They wouldn't be able to create money out of debt.
Well, and I think that's what they would hold. They would hold public money. They would hold sovereign money. It wouldn't be private debt created money.
That's right. That's right. But again, that's a payment system function. So what we're doing now, if we can get beyond this, and this is where I think probably the ideas of MMT are helping, even though things can get confusing, is that if we need to deficit spend to spend on infrastructure and all of these things, we should do that, and we should do it explicitly with Treasury money, and not worry about the financing, not worry about what the Federal Reserve does. The problem I've got with the Federal Reserve is they got lots of worthless paper that they're holding as a result of the 2008 financial crisis, where these banks, you know, made all of these bad loans. And again, I would say, you know, I would bail out the homeowners, not the mortgage companies. That was the 1930s solution, and that should have been the solution more in the past and in the future.
It does get complicated when you allow the system to keep working as it is structured, and you start doing the MMT thing. I'm much more for how do we get rid of all the private debt-based money, get to public money, but we have to figure out the middle ground. There's no way we're going to get
I know. I mean, that's the basic dilemma, and they recognize that actually in the 1930s. You know, how do you make that transition? You're not going to make it overnight. But remember, there are some things happening in the payment system. The private sector is taking a greater role in the payment system, and so that's good. And to the extent the government gets involved in making loans to help infrastructure and climate change and all these other things, that's a good development. You can't solve everything, unfortunately, at once, but there are some positive developments. We've still got, you know, the problem with the Federal Reserve balance sheet and how we're going to get out of that, what's going to happen. But again, I don't worry about the size of the deficit, and I think the government needs to spend.
Thanks for riffing with me.
Okay.
Thanks, Liam. Let's go to Paul and then Joe Polito.
Hey, okay. Yeah, kind of following a little bit on what Liam is saying. I'm thinking that we're still kind of holding on to antiquated concepts. You talk about cash, which doesn't really mean anything anymore. All money really is in the form of bank deposits. So, and I'm wondering if there's this line between credit and money is artificial now. You talk about banks lending their equity, but what is their equity? It's the money that their investors, the shares that their investors buy.
It's a shareholder, yeah.
And it's really government. If we have the Treasury being the only creator of money, that equity would actually be made up of government-created money. So really, the credit is also would be in the form of government-created money. So I think that it's getting blurred between credit and money.
And again, that's right. That's right. But that's why, conceptually, you have to keep thinking about, okay, credit and payments are separate. But you're right, things get real confusing. There's lots of things that, and especially these days, is it credit? It's debt money. So that sort of makes it that merges basically credit and payments. So it does get very confusing. But I still think of things like what PayPal and Apple Pay and those things. Okay, those are payment systems where it's very convenient and very efficient to transfer value to buy goods and services. Well, that's the private sector doing that. Well, that's just fine. Do we need banks to be doing that and take operating the payment system and making loans? No, we don't need banks to do that. We could have totally separate firms operate the payment system. The credit then has to be out of basically equity. Okay, and whether or not it's converted, whatever type of money it's converted to, doesn't really make any difference. I mean, it's going to be digital money, and stuff.
Right. Well, I mean, I could see outsourcing some of the logistics of the payment system, but why can't the Fed, why can't the government be the ultimate source of, like CBDC, central bank digital currency? That's the payment system, and if we want to hire Apple or PayPal to manage it, that's one thing. But really, it should be a governmental, basis for payment.
Well, here's what I would say. Again, if you go back in the history of the Federal Reserve System and U.S. history, remember in the 19th century, we had thousands and thousands of currencies. Okay. And these currencies, they had floating exchange rates within the United States. Mm-hmm. A dollar in New York was not the same as a dollar in Chicago.
Right.
All right. What the Federal Reserve did in 1918, this is 5 years after it was established, the Federal Reserve said, okay, we will give you Federal Reserve notes for gold at par value, whether you're in New York or Chicago or San Francisco. What that means is the Federal Reserve took over a monopoly in the payment system. And for many, many years, that's the way it operated. The Fed, remember, the Fed had their own fleet of airplanes flying checks around to be cleared. That seems really ridiculous now when all we do is use our iPhones and take a picture of the check. But the Fed had airplanes flying around checks to clear the different cities. That's a huge inefficiency and waste of resources. So the problem has been the Fed has a lot of monopoly. So the extent we can get private sector competition in the payment system, I think all that's good. And there's still going to be a role for the Fed because the Fed issues the ultimate money. We don't have gold anymore. It's Federal Reserve notes. It's Federal Reserve liabilities are the ultimate money. So the Fed is still there, but you can have a very large role for the private sector. As far as, again, making loans, the Federal Reserve started out discounting or buying and selling short-term commercial loans. Well, now they've, again, as a result of the 2008 crisis, they got lots of basically worthless mortgages. They're still holding and stuff like that. And that's a total perversion of anything the Federal Reserve should be doing. Again, I'm in favor of the Treasury making loans to help promote the private sector, and I'm in favor of the Federal Reserve taking a role in the payment system, but a reduced role that allows the private sector to do quite a bit as well. We'll see how that works out.
Thanks.
Joe, go ahead with your question. Joe Polito.
Hi, Ron. That's a
hey, Joe.
Great presentation. Really been enjoying it.
Okay.
I'd like to get your thoughts on a proposal by economist Michael Hudson, who recognizes the Henry Simon approach might lead to a deflationary process. If the government was only issuing, if the government was the only issuer of money. And he suggests that the solution to that concern was that over and above the banks lending capital and investors' money, they would have opportunities, and they had more, profitable opportunities and idle resources to fund entrepreneurial activity, that those banks could borrow from the government or the Fed, which of course is just the reverse of what's happening now.
Well,
you think that's a good suggestion?
Well, again, I'd go back to the Reconstruction Finance Corporation, and people forget this. And actually, this happened in the 2008. But the Reconstruction Finance Corporation, by about 1935, owned half the banks in the United States. Okay. The federal government owned the banks. Okay, they were the owners, and the banks had to issue shares that the federal government bought. Then, when the banks recovered, the banks bought back those shares, and it was profitable for the government. So, yeah, if you think about that now, the government could do exactly the same thing. The government, the federal government, do something like, again, I'd say the Reconstruction Finance Corporation, could take equity ownership in banks. Again, they did that in 2008. George Bush did that, to save the banks. Go back and look at it. People say, "Oh, that's socialism." Well, yeah, you're right. Roosevelt did it. Bush did it. Okay, and that's government ownership of the banks. Now, we don't have to have a financial crisis in order to do that, and it can certainly be the case that the federal government could take some capital ownership in the banks. Again. The history of the Reconstruction Finance Corporation, when you realize they were basically took over most of the industry in the United States in the 1930s, and that's what helped us not only get out of the Depression, but fight World War II. Then that's a model that some lessons we could use actually today in terms, again, thinking about, well, we don't have to get the banks totally out of it, but we might want the banks to do something else. Now, there are not to get too technical about, things like the Community Reinvestment Act and things like that. There are things that try to get banks to invest in their communities, stuff like that. Those things haven't really worked very well. What I'm talking about is the federal government takes ownership, buys equity stake in the banks, and the banks have to use that money to make loans to communities or whatever it happens to be. It could be housing.
Okay. That's a great idea. I think I read that in Korea, the Korean government is the majority shareholder in the banks, and it does what you say. Plus, it also practices credit guidance.
There's nothing wrong with government ownership, except especially when it becomes profitable and you return money to the Treasury. We did that in the 1930s. We did that in 2008. After to the extent, again, there was equity ownership, and then they bought back the stock. But we didn't do that. On the other hand, if we have the Federal Reserve just bailing them out, that's basically a loss. We don't want that. The way to save the banks or get the banks to change is, as far as the role of government, is take equity ownership, and that's socialism or whatever you want to call it. And it's worked in the past, and it will work in the future if you do it right. Could be a disaster, if you don't.
Thanks. Virginia, I think you had a comment on the functions of bank, and we could get Dr. Phillips' take on that. Then we'll go to Hobart, and then we'll go to our other lead. Go ahead, Virginia.
Well, I just said I think it's more helpful if rather than saying that banks have two functions, to say they have three. They,
okay.
The lending, intermediation, payment systems, and money creation. And in our current system, the lending and money creation are conflated.
Yeah.
And in a sound system, they would not be.
Exactly.
Yeah.
No, that's exactly that's the essence of the Chicago plan is you separate those functions. Now, it could be within the same institution, but you would have to separate those two things. The payment system, you'd hold safe assets. The credit system would be, equity financing, whatever you wanted to do. Again, in terms of talking about what the Chicago plan envisions is more direct finance rather than indirect finance or intermediation, which is what we have with banks. The banks, the intermediation process would definitely change under like a pure Chicago 100% reserve plan.
Thanks. Go ahead, Over.
Dr. Phillips, good to see you
Yes.
again.
Yes.
Picking up a lot of interesting, micro insights about the history of this.
Yeah.
I want to focus on research
Okay.
that has advanced the Chicago plan.
Yeah.
And that's very important for us because, in our rhetoric or in our promotion, we talk a lot about the Chicago plan. We talk about Zarlenga's historical investigations, that there are historical examples of sovereign money.
Yeah.
A big boost, of course, came with the Kumhof-Baynes paper,
right?
Titled "The Chicago Plan Revisited."
Yep. Yeah,
and they even came to conclusions that the plan would even be better than the Chicago economists would have thought. So my question is, what other research are you aware of that is advancing, that is strongly advancing this proposal and its underpinnings? And what other research should be done? And I'm asking this specifically because both the American Monetary Institute and the Alliance have some money out for economic students for an essay contest. But we need questions, what should be still looked at? So,
well,
go ahead.
Well, okay, what I would say is that I've thought that if you go back and think about the history of banking, okay, there are people that advocate the free banking. This George Selgin and Larry White. They're free bankers. And what they say, if the government hadn't been involved at all, then this fractional reserve banking would work. The only thing that messes up fractional reserve banking is the fact the government gets involved. Well, I don't think that's true. I don't think it's factual in terms of looking at the history of banking. If you look at the origins of banking, and I think this is where, again, people get confused, but again, Randy Ray has written a lot on this, very good in terms of monetary history. Banking didn't start by the goldsmiths loaning out warehouse receipts, because warehouse receipts meant you had to have the gold in the vault. If you loaned out the gold that was in the warehouse, the king would chop your head off. So it didn't happen that way. What did in fact happen is through lending. And what would happen, there would be some innovative entrepreneurial person what they would do is issue very short-term debt, maybe even debt on demand, say this is payable immediately on demand in like $1. And what they would do is issue those, and those could be used as a convenient type of money. But what are they holding as assets? Well, back in these times, they're holding lots of gold, plus they're holding longer term debt. So the way banking does evolve from debt, but that's quite different than saying, you had 100% reserves like the Bank of Amsterdam, and then they started loaning out. Well, when they started loaning out, they went out of business. So one of the things is just learning from the history of banking how it works. Now, what this means is that if you start looking at, what's happening today, I think many of these private sector developments are okay and they're fine. We should have a greater role for the private sector in the payment system, but we also have an appropriate role for government in lending. And that goes back to the idea of the model of the Reconstruction Finance Corporation. So I would look at, in terms of research questions, one, what can the private sector do with the payment system in the future? PayPal, digital monies. I know I've had some discussions with some of the people that are creating digital currencies. And to the extent they hold 100% in safe reserves, they're basically doing the Chicago plan. But if we want government to make loans for infrastructure and climate change, we need to do that right as well. We don't want to just, make loans and not get paid. We want them to be accountable. So I think that that's something you can learn from history, but you can also look at, well, what's going on right now that would help, solve problems into the future, because we've got lots of innovation happening in the economy today, in the payments and the financial system, and so there's a lot of stuff there. I've always said that the Chicago plan is not going to happen because Congress decides to enact it. It's going to happen basically through evolution and innovation, and I really get that. Again, if you go back and read Minsky and Henry Simons before him talked about innovation in the financial system. That's what's happening. That's what you've got to look for.
Yeah, we might come back to you then to sharpen those questions for economics economics students. But as far as, let's say, beyond the Kumhof paper and after, for me, someone who did his PhD on the federal, on full reserve banking, Patricia Laine from Finland.
Yeah, I know him. One of the nice things is every with the emails, everybody's contacted me. There's also Samuel, and I don't know how his last name starts with a D, from France, who's recently done a dissertation. I've got his name and everything. I just don't know how to pronounce it in French. He's done a dissertation. So there's lots of people all over the world that have written about this and then trying to do these things in particular countries. So there's lots of stuff there. Yeah, Kumhof is great. I mean, that really, his was very mathematical and stuff. And so, people got pretty excited about that. And he's, I guess, still at the Bank of England. So,
no, correct. Probably Joe and I will get back to you to get.
Yeah, sure. I'm happy. Yeah, I can provide some other suggestions.
Yeah. Thank you.
Okay. Sure.
Hey, let's move on. Thanks, Hobart. Liam, go ahead with your question, please.
I think it's pretty much been answered already. I was just asking. I wanted more, details about how if implemented, like the creation of money, what it be used for specifically, and what that might look like, or resources to look into that maybe a little bit more. But that's mostly what I'm interested in, like what kind of economy that would look like, or if there are previous examples of that.
Well, you get the question. I mean, I don't know what I would say is just there's lots of innovations and types of money, and I think looking back to the history, like when we had banknotes, I'm actually a big advocate of local currencies. The local currencies are not a bad idea. I've got a little proposal on my webpage about the beer standard, about how you could have, we have lots of microbreweries in Fort Collins, and the microbreweries could start issuing basically notes redeemable in beer, and those things could circulate. There's lots of things. There can be lots of innovations, and a lot, people are talking about the digital stuff. That's obviously pretty big as well. So there's lots of things going on, as long as it's safe. If you trust Apple Pay, you trust PayPal, or all of these others, then that's great. Now you might ask, well, what happens if there's some crisis in one of these payment systems? Well, that's going to be an interesting question. But again, it shouldn't be a problem, especially for somebody like Apple. Apple's not going to be insolvent anytime soon, and it's always going to have plenty of liquid assets. So Apple Pay is probably pretty safe. So, but there's lots of things going on there.
Okay, thanks. We're going to have to hear more about this beer currency offline.
Okay.
Very
okay.
Interesting.
Yeah, I've got it on my webpage, but a presentation.
Let's go with Sue, then Jeff Elder, then Lucille, then we'll go back to Paul again. Go ahead, Sue.
Right. Hi. Ronnie, I have a question. I got a little confused. I came in 10 minutes late. Maybe you clarified it. But when you were talking about we could add more private parties to the payment system, the 12 Federal Reserve banks are privately owned, right? Already.
Yeah, that's where you start getting into some basic questions about how does the system really work. That's technically true. The Federal Reserve banks, they're in fact chartered by the Office of the Comptroller of the Currency, so they're sort of nationally chartered banks, but they are their equity ownership is the commercial banks in their district. But the thing is, there's not a market for Federal Reserve Bank capital. I can't go out and buy a share of the Federal Reserve Bank of Kansas City. Now, if they would allow something like that, which I might be very interested in, that would be great. What we have now is not really private ownership because you can't go buy a share of the Federal Reserve Bank of Kansas City. So it's kind of a fictitious. It's still it's the government, and it's controlled by the Board of Governors, Federal Reserve, Washington D.C. So it's not what I would call a private banking system.
However, the commercial banks, the members of the particular Federal Reserve Bank, their stocks are publicly traded and owned by very wealthy people a lot.
Yeah. That's true. But I'm saying, wouldn't it be great if you could buy one, either if you could have a deposit at a Federal Reserve Bank, or if you could buy a share of a Federal Reserve Bank. I used to always ask my money in banking classes, if I gave you the power to create money, do you think it'd be a profitable business? Do you think the Federal Reserve banks are profitable businesses? They're hugely profitable businesses, and they return money back to the Treasury. and I mean, it's a funny system, but it's not really private ownership in the sense of what we mean by private ownership in the rest of the economy, which is you can go out there and buy a share. You can't buy a share of the Federal Reserve Bank of Kansas City as an individual. And that's a problem. I mean, I guess it's a problem. It's certainly not, it's not private enterprise.
Okay, thank you.
Thanks. Okay. Jeff, go ahead with your question. Jeff Elder.
Hi, Ronnie. This actually addresses one question that Liam put forward to you.
Okay.
Of course, this applies to Canada. So if Liam wants to go to Progressive Money Canada, right on the front page, there's a short video on transition to a sovereign money system. Yeah. And in it describes how you would transition to like 100% full banking.
Yeah.
And anyways, that's all I wanted to say.
Well, yeah, and again, there's been a lot of discussion. It wouldn't, even in the 1930s, there's lots of discussion of how to transition. It wouldn't be technically that hard, but the basic problem is just getting the politicians and the bankers to go along with it, and it's just a political opposition.
That's another thing.
Technically, it's not hard.
That's another thing I wanted to point out is that legally you wouldn't actually have to change anything. All you would have to have is a mandate from Parliament to actually just use the Bank of Canada to absorb all the security issues.
Exactly.
And then from there, then you could start to, rein in banks and that kind of thing. So,
yeah, and again, that's a lot of people have proposed that. Actually, a guy that Ken Spong, who worked for the Federal Reserve Bank of Kansas City, had basically that proposal worked out on how to transition. It's not really that technically a big problem. It's just politically a big problem.
Which is a big problem.
Right.
Thanks, Jeff. Go ahead, Lucille.
Hi, Ronnie. Thank you for talking with us and sharing your research and your perspective. I do have a question about an author in a book you haven't mentioned. I just do want to piggyback on Sue's question about ownership of the Fed. And while I can accept your statement that it's not typical private ownership as in other companies, it sure as heck ain't typical public ownership either.
Exactly.
And, I think that deserves to be said.
No, I agree. And again, if you go back to Henry Simons and Chicago Plan, in their initial proposal, what they want is outright federal government ownership of the Federal Reserve.
Right.
You're right. So, that should be government. There's no question about that.
Right. And so, that's what the Alliance for Just Money, I think you realize, exists to advocate and work on. And I'm a little saddened or disillusioned by both you and Liam, who had to leave early. You're, saying that we have to take piecemeal steps that we can't. So I want to get to my question anyhow. And so my question is I guess also before the question, I was a little surprised to hear you reference Morgan Ricks, and I have read closely most of his book called The Money Problem, except at the very end I ran out of time. But he defines sovereign money very, very differently than we would, and basically defines it as FDIC insured money. And that is a very inadequate definition. But my question is whether you're familiar with a book by Macmillan, a team of authors, one of whom is not public, so they go by a pseudonym called Macmillan. It's called The End of Banking. Is that a work you're familiar with?
I don't think so. I probably come across a book called The End of Banking, but I don't know that particular one.
Well, I would, then I wanted to ask what you thought about it, but I would recommend it. I know not everybody here at the Alliance has either read it or fully, doesn't all agree with it. But to me, they are advocating for sovereign money, and they basically locate the origins of modern money and banking in the 14th century technique of double entry bookkeeping. And the gradual development of what they define as banking is the creation of money out of credit. And that is what they want to end. And as far as I understand, the American Monetary Institute and the Alliance for Just Money and the Chicago Plan, that's what we want to end. And their proposal for doing it is basically a simple change in accounting rules that they define as sort of they call a systemic solvency rule. And, and they're applying it to all companies, but the ones that it's going to affect are banks and other financial institutions, especially after the end of Glass-Steagall. And, I think if I'm getting it right, they say the value of the real assets of a company has to be greater than or equal to the value of the company's liabilities in the worst financial state. And the latter part is how they get the shadow banks and the insurance companies. And then they separate, just as you've advocated, they separate money and credit. And that money is wholly, entirely in the public sector. Money is created, and when we reach that time when there's too much in circulation, it is extinguished by the public. And it is, and they have a very specific advocation for how it should be injected into the economy, which is debatable, I think, but it's thought-provoking politically in that they advocate all new money, newly created money, enters circulation, not through a basic income by what they call an unconditional income to each and every citizen, no matter the age in the economy. And then they have a liquidity fee, and that's a circular flow. And then they advocate that all credit, the saving and the lending and borrowing of already existing money, that happens in the private sector, peer-to-peer lending, the institutions that you've advocated. And so it seems to me, listening to you, that, you know, their proposal, unless, you know, and there are some minor points in it that I disagree with them on, but I think that could easily end a little correction. But, you know, I think basically their proposal makes sense, and it, you know, it is a way to get to sovereign money. And we've seen the need for it in the 30s. We've seen the need for it in the 2007-8. And we don't need to wait for another breakdown, and we don't need to settle for half measures. It seems to me they lay out a pretty decent approach that is very compatible with the NEED Act, as far as I understand. So yeah, I would be interested, if you haven't read it, just based on what I've said, if you could comment, and I'll.
Well, I'd like the reference on that, and I'll have a look at it. I don't believe I've read it, but everything you've said sounds consistent with what I've said about the Chicago plan. And it also is very consistent with what Henry Simons described as the financial good society. He wanted basically government created money, and that was it. And then private sector lending through equity. So the basic idea, I'd be surprised if they don't quote Henry Simons in there as well, because that's very consistent. That sounds like a description of what Henry Simons said was the financial good society. So I would be interested in taking a look at that. And again, always, you know, I know it's always a question of, in terms of reform, can you do the big thing or can you do it piecemeal? Well, I tend to think, well, maybe there's some piecemeal things that are helping us move in the direction that at some point you can get big reform. I don't know.
Okay, thanks. Let's go with Paul and then back to Joe.
Okay,
thanks. I think probably piecemeal is the way it's going to have to go, but in the process of these piecemeal changes, I think there needs to be a broad understanding of what the final goal is, and we shouldn't hide it. But okay, what I'm having difficulty in grasping in some of the things you're saying is it seems like making a profit should not be should not be what government is all about. Government should not be in the business of making profit. So it's not something that I see as a plus. I would rather, I can see innovation, but, we have a legacy system that we seem to keep trying to shoehorn these innovations in. And I'm more for simplification and just making things very straightforward in terms of what does it mean to land equity? Well, again, I'm not sure I quite got it, but it seems the equity really would only be government-created money under 100% reserve banking.
You've got assets, whatever they are, house, car, financial assets, all of those things, and then you may have some liabilities. If you have loans or something like that. that difference is the net wealth or the equity. And that's what I'm talking about. Now, how you hold that equity, it might be just money you've got in the bank account or a savings account or in a mutual fund or Vanguard, whatever it happens to be. So that there is net wealth, there is real wealth in the economy, where because assets exceed liabilities. Sure. Now that's separate from sort of the issue of money. Again, I always come back. I mean, the money is just the payment system. How you if you decide to make a loan, and how you do that, you loan cash, you loan write a check, whatever that happens to be. The other thing I would say, you said something about government making a profit. Now, again, I don't have, let's take the example of space exploration. Now, the private sector wasn't willing to do that. And so the government goes into space exploration as a nonprofit, basically. They're doing that. Now, these days, it might be that what the government ought to do is buy some shares in a private company that's exploring space. That could be a profitable thing for the government to do. But that's two totally, separate types of activities. And when I talk about what the Reconstruction Finance Corporation did with both industrial and financial companies, they bought shares. They took equity ownership in these firms, both industrial firms and financial firms. But yeah, certainly the government can do things for not a profit as well. I don't have any problem with that whatsoever either.
I just think that's the primary job. The government got tanks, battleships, planes. That's what we wanted. We didn't care about making a profit. Right. We shouldn't.
That's exactly. So. That's right.
Yeah. Okay.
You're right. You're right. Okay.
Thanks, Paul. Go ahead, Joe, and then we'll go back to Matthew Sparks. Go ahead, Joe.
Okay.
Hi. I've been putting a few links in the chat.
Okay.
One of them was to Ronnie's book. There's a 25-year anniversary edition, and it's got all sorts of added features in it in terms of correspondence and so forth. And it's a great read, and I think Paul already got it as well. He held it up. I put in a link to Eccles, the great Mariner Eccles, on the ownership of the Fed, and he actually addresses that issue much the way Ronnie described it. And by the way, there's a great book on Eccles called Jumping the Abyss, which I highly recommend, and it does refer a lot to Lachlan Curry. I also have a link to Jeff's video and website. And finally, and to my question, I have a link to the Bank of Spain, which published on CBDCs and feels that it's a real path to the Chicago plan, a much easier path. And Kumhoff has said the same thing. Any thoughts on that?
Yeah, no, those, I'm just looking at those links now. Yeah, and I would like to have all of those in the books and things that people have mentioned. Yeah, I want to be sure to get those. And if people put emails and things like that, I guess we'll have access to all of this after the thing's over. But yeah, I'm very interested in all of these comments. So,
thanks,
but yeah, I don't know anything about the Spain thing, but I'd like to look at it.
Thanks, Ronnie.
Okay.
Go ahead, Matthew. Then we'll go to Ed Dotson after that.
Okay. I would just want to talk a little bit. Well, first I wanted to say, I like the other comment about the government not profiting, but I do understand that if they can go to space and no one else in the business world wants to do that, if there's profits, I think those should be, there should be a plan for that. Like, where does that money go? I don't like it going into the general fund, but anyway, that's neither here nor there. My question was about long-term loans. I can understand how the government can do those, infrastructure and everything.
Yeah.
But I'm really, really scared about short-term loans. People, if I'm assuming we're relying on people going out and getting their own loans, correct, from the banks and
yeah.
Okay, so short-term loans. There's going to be problems of discrimination and things like that. And that has to be addressed. Do you have any ideas?
Well, no, I agree with you. I don't know that I have any ideas, but certainly, short-term lending is a problem. And remember that Henry Simons wanted to abolish. He thought that was the worst thing in the financial system was short-term loans. He wanted all lending to be basically infinite maturity or 100-year maturity. And so there wouldn't be any short-term loans. So, because I think you're exactly right, the problems do.
But yeah, even if they were 100, that still doesn't answer the question. If I'm going into a bank and these people don't like me, and you say the wealth is out there, the wealth is in a certain amount of hands. And if they don't like me, they're not going to give me a loan.
Yeah, but I don't know what
I have to be able to go to the government then.
Yeah, if there's not any private sector alternative, but again, I mean, if the government's going to do it, and again, Reconstruction Finance Corporation, I think the maturity of those loans, I don't know what they were. None of them were, like 20-year loans or anything like that. But what you have to do is you've got to have the resources to monitor those loans, and it may be very costly to monitor those loans, but it just depends. But it's a problem, and I don't have any.
Yeah, that is going to be a problem. And it's like payday loans, for example. People at the very low end of the stick.
Well, I've done research on payday loans as well in Colorado. And that's again a problem of payments and lending. These people have payments problems, and they're being charged fees, for these checks, which again is a payment system. But then when you calculate those fees as a loan, it's very high interest rates, and that's definitely a problem. And I think again, there's an appropriate role for government there in terms of doing something, and maybe even of course the Federal Reserve, since it's a payments issue problem. But payday loans are definitely a big problem that needs some solution.
And this is where I would think you could connect the idea of public banking. I know I've looked into that too. The Alliance for Just Money. I really like what you guys are saying, and Ellen Brown has this North Dakota model, which I don't really get on board with. I don't think it's so small of focus. But anyway, I think I do like the idea of if there were public banks, and if they might have to use like federal money to get to people that cannot access credit in any other way, or it could be the city or the state or the county. But we just can't say throw it open to private lenders.
Yeah, and again, there's a long history in the U.S. of small firms. There used to be a thing, they were called Morris Plan banks. And the purpose of Morris Plan banks was to make loans to working people back in the early part of the 20th century. And they ended up going out of business because you had savings loans and other things come about. But Morris Plan banks, they were explicitly to loan to working people. And it was a private sector development, this guy Morris. And they later evolved into what's called industrial banks. And so if you see an industrial bank charter, that's sort of the successor of the Morris Plan institutions. But again, in U.S. history, there's been benevolent loan societies and all of these that have tried to play a role to make loans to people who are deemed not creditworthy. And the creditworthy, one of the things they've, of course, found out is just because you're low income doesn't mean you're not creditworthy.
Exactly.
And the question is, how do you get the information about it? One of the things I've said, the government could do is give everybody $100 and see who pays it back. Something like that. I mean, that would give information about somebody's creditworthiness that then the private sector could use. Because the problem often with if you're, I know people whose jobs are not, steady, or who do, either because it's at a period of time, or they just change jobs a lot. They don't have a good credit history. But I think there are ways to overcome that. And that can be both private sector profitable innovation, but it can also be various societies, various groups, or even government that could get involved in that as well. But that's a basic problem of information. And that certainly needs to be the problem of the unbanked. There's been a lot of research on that. And there are things that can be done about that. And maybe digital Federal Reserve digital currency or whatever, having everybody have a bank account, a free bank account at the Federal Reserve Bank might be a way to solve a lot of those problems people could establish. Often, the reason you're not credit worthy is because you don't have a bank account. So.
I just want one other real quick comment, and then I'll let somebody else go. Is I think if we're going to talk about public money and the government printing all the money, the citizens have to have a base, an asset base by right almost. And that's where I kind of flake off on my, forming this asset base to make you bankable no matter who you are and no matter what your circumstances are. Would be your house. Your home is your castle. And with that, I'll just shut up. And that would be funded by the government.
Yeah, and that's okay. But let me just say one negative about home ownership. Home ownership reduces your labor mobility. A lot of the problems of people that work for automobile manufacturers is that they own a home in Michigan and they can't sell it. What do you do there? Now, maybe what you do is have the government come in and buy those homes. Exactly. But that's the kind of thing that would have to be done. So home ownership. I mean, Roosevelt obviously was big on that. But if it impedes your mobility, it can be a negative.
Yeah, it doesn't have to. You can have housing stock is the responsibility of a nationalized home lending bank. But anyway.
Yeah.
Thanks, Matthew. Go ahead, Ed.
There's so much that could possibly be discussed.
Yeah.
I just to respond very, very briefly to Matthew. I spent the last 20 years of my career at Fannie Mae, so we tried to make as many households a homeowner as possible in this country. And there were good parts to it, and there were there were risks that were associated with it. No doubt about it. Yeah. But that could be a whole other discussion. But to tell you the truth, Ron, what I wanted to bring up is a little bit off the subject of what you've been talking about, and just to put it in context. Back in the 90s, I was fortunate enough to be added to a group of economists and some other Western advisors who went to Russia to talk to the Duma about privatization. And my task was to convince them not to adopt our financial system because of the mistakes that we had made and the problems that our financial system had caused. And one of the economists who was with us, we met with a group of Russian economists, and he said, have you ever thought about securing your currency with construction bricks? I thought, that's really a strange idea. But it turns out it came from James Buchanan at the University of Chicago. And the more I thought about this, I thought, going back to a gold standard, and there's still many gold bugs who want to go back, people at Great Barrington, AIER, believe very much in a gold standard, but gold and silver, it seems ridiculous to mine ores out of the ground just to spend all the money to put them back into a vault somewhere and all the money to secure it. But construction bricks, it wouldn't, there's no environmental damage to producing them. They don't need the great security. And they have all the, this is what I came to agree with it. They have all the positive and none of the negative characteristics of precious metals. So I think Buchanan was onto something.
Well, okay. Well, let me add to that, though. Actually, in my discussion, I have this talk about the beer standard. I talk about the brick standard. That actually comes from Charles O. Hardy, who was a professor at the University of Chicago, who Buchanan studied under. So it's really from Charles Hardy is the one who has it. So I have in my presentation a discussion of Charles Hardy's proposal, and you can look it up if you just, I think you should say Charles Hardy brick money or something like that. You can find his, but no, I think it's very interesting. And I use that as a basis to talk about having a microbrewery issue money, because what they have is a pint of beer. Okay. It's not going to be gold. We're not talking about using gold, or it's a commodity money, but it's going to be beer. And you can think about it the way you think about like the bricks, and you're exactly right. The brick standard is that's a famous example.
What I think is unique about bricks is they have a
alternative use.
Global demand that's stable, and it can be produced with the same quality anywhere in the world. But I don't hear anyone else discussing this as an idea.
No, but that's all in Charles. Charles Hardy talks about all that, and I don't know whether it's, it may be that Charles Hardy didn't write it down, but he talked about it in his class at the University of Chicago. That all of these other economists have written about it. I think you'll find Milton Friedman mentioning the brick standard as well. But Charles O. Hardy is the name you want to probably Google, and I'm sure it'll something will come up. Okay.
I want you guys to consider a people standard. I mean, that's what we're about, is people. So you can use people just as easy as you can use bricks, and people go up with population and go down. So, but go ahead, Paul, with your question.
Okay. I don't know if I'd like to wake up in the morning and find a piece of my house gone.
That's happened in places like where there were older bricks on older brick homes, and people drive up in the middle of the night to abandoned houses and take off all the brick siding.
Exactly. Yeah. But they do it with copper and wiring. I'm not sure if this is an example where if your only tool is a hammer, everything looks like a nail. I'm not sure. It just seems that the need for credit shouldn't be there for most people. And so framing everything in terms of credit and loans and innovation in lending may be a kind of a symptom of the fact that we're not providing our citizens with what they need. And so, but I have another question, and because you've been there, you shared one very close partnership with Randy Wray, and I was wondering, do you have any insights into why he is so vehemently against the Chicago Plan, sovereign money, and so on? What's driving that? Do you know?
Let me tell you a little story. I've known Randy my entire career, and basically his entire career as well, because he's at the University of Denver. And of course, he was a student of Minsky at St. Louis University. And so what Randy once said to me when we were talking about this, he said, "How did you ever convince Minsky about 100% reserves?" So Randy's asking me this. And I said, I didn't convince Minsky of 100% reserves. What I did is I reminded Minsky about the 100% reserve plan. And Minsky, and he wrote in the introduction to my book, and then in one of the last papers he did at the Federal Reserve Bank of Chicago conference, he advocates this 100% reserve plan. Now, I think Randy thinks that it's not really it's not politically feasible, and it's not really necessary. And I can see his point. I mean, there's something to say that there are other ways of doing things, and so I don't Randy if you look at his modern money theory, he references my book and says it's a very good book. To say he's vehemently opposed, he just doesn't think that that's the solution. But I'm just saying he's perplexed that Minsky advocated it, and he's Minsky's student, and he's the leading person talking about Minsky. So again, Randy and I are, good friends and stuff. And so I wouldn't say, I mean, the opposition is just, he's got some better ideas. And again, if you read Randy's history of money and all the things, Randy's definitely worth reading all of his stuff. He's very productive guy. I think he's kind of retired more or less now, but like me, but he's still doing stuff. Stephanie Kelton, has been the one who sort of picked up the modern money theory, and she's sort of the leading advocate of it. And I think Randy's views even of that are a little bit different than what Stephanie says. I would read Randy's book, Modern Money Theory, and he calls it Modern Money Theory, not Modern Monetary Theory. Right. Stephanie, and Randy's got a lot of history, and there are many things, about that. So.
Well, Stephanie has the limelight, that's for sure. So
yeah, and that's she's younger. I mean, she right. She's done well. I mean, I have her book too, and that's I know Stephanie and everything. So
well, maybe someday in the future you can explain modern monetary theory to us so that we can understand it in the future.
Well, I mean, just quickly. I mean, you got to keep the Fed and the Treasury separate. And then say, suppose they're collapsed together. And that's basically what they're saying. I mean, there are some similarities what they're saying to what Henry Simons is saying. Okay. But in terms of, the government can create as much money as it wants, subject to inflation. Well, that's what Henry Simons said.
Right. The trouble is you just need a law to allow the government to do that, which doesn't exist yet. They don't want to say that.
Yeah, I mean, So, yeah. But it's interesting. And again, Randy Ray's the one to read. I mean, Stephanie's good too. But Stephanie's is a popularization. It's written for the layperson, and it's written to sell books. Randy's is a much more technical thing, and it has much more detail about it.
Okay. We're down to our last 10 minutes. I just wanted to ask one question. I wanted your opinion on one thing. Then I'll go to both over to Jeff. It seems to me that the monetary system, and particularly modern monetary theory, as Ray and as Stephanie talks about it, has a certain bent on a Western view of the world view, and that keeping that intact allows U.S. hegemony to continue and allows Western countries to continue their domination over economies because the debt system that's created. Because they can, as the U.S. and essentially can create debt unlimited because we have such a large economy, but it puts smaller economies in such a small or such a great disadvantage that it's not fair. And that's one of the driving forces why I'm in favor of sovereign money by individual countries. And then we go to Howard. And then...
No, I agree with you. And again, remember, I like the idea of local currencies. And local control. And certainly when you talk about, individual countries, yes, there ought to be greater control of individual countries, and there are ways to do that. So, but that's another topic.
Yes, it is. Go ahead, Howard. Quickly, we got 2 minutes left, so make a quick one.
I like to talk about the political force fields around the Chicago plan. So we know that in Switzerland they had that referendum to change the whole system there, and banks and central banks were very opposed to it, and even reverted to outright misrepresentations to persuade the public not to vote yes. But in the 30s, what were the major players that were in favor of it or were against it? And was there some homogeneity in there? Were all bankers against it, or what was the fellow position?
All bankers were not against it by any means. When I was doing my research, I found a banker who had refused to join the FDIC and went to 100% government securities, and so he refused to join the FDIC because he's basically saying I have a safe bank. And then there were just other there's plenty of bankers that wrote in favor of this. But, you know, ultimately what happens is, I think just the bottom line, you got the big New York banks that have always been there, probably always will be there. And they wanted to get bailed out by the government when they had losses. And then when things recover, they want to keep the profits. And that's been the problem of the United States banking system, the entire history of the United States. So there were lots of politicians. There were advisors. There were bankers, academics, obviously, that were in favor of it. But ultimately, it just wasn't enough. I mean, and some of that, again, it's, you know, not really pushing the book, or you can read the working paper that sort of tells you what happened. But as I said earlier, what ends up happening is there's just the bankers are threatened with this idea of 100% reserves, and that gets them to go along with federal deposit insurance. That's what happened.
Thank you. Let's go with Jeff. Jeff, you'll have our last question for the evening, so let's make it a good one.
This actually kind of goes to Paul's comment, but we don't have enough time to go into this. But I have a real issue with MMT descriptive analysis. So this is addressed to Ronnie. Mm-hmm. Anyways, like I said, there's not enough time, but yeah, I put in a link, and you can find it on the Progressive Money Canada website, and just go along the header bar, go to debunking MMT, because there's lots of things I like about MMT, but it's really the descriptive analysis that is very problematic.
Okay.
Thanks.
All right.
Thanks, Ronnie.
Okay. Yeah, sure. Enjoyed it.
We got 5 minutes left. I thought Jeff was going to have a longer one, but he shortened it up. Any final questions or comments or statements from anybody? Virginia, Lucille, Mark Pash, Joe Bongiovanni, is he still here? He's still here. Anyone? And if not, I won't push it. Trust me.
I just go ahead. No, I was going to say I've really enjoyed this, and please feel free to contact me if you have any further questions. But yeah.
Okay. Go ahead. Let's go with Mark Pash, then we'll go with Matthew right quick. Go ahead, Mark.
Yeah, answered a lot of the stuff in my book. We don't get that as we break down the money in two systems. One, the creation of the money, and the second one is the distribution of money, which is a key factor. And I know with the dynamic economy we have in the global level, having the government do all the distribution without going through private enterprise too, is kind of a naive way of looking at things. And it's naive from an economic standpoint and a marketing standpoint. So these commercial banks, big and small, can become a distributor because they're the ones that are qualified to underwrite loans. There's very few others other than some mortgage brokers out there that can underwrite loans or be trained to underwrite loans. And it's slow. So we have to really look at the system from a distribution standpoint, which is the real problem. The ownership of the Federal Reserve is a minor problem because you can set the Bank of Japan and the Bank of England and the EU are all public entities totally. And it's the system they're running that counts, not who operates it. And so in order to accomplish what we have to accomplish, especially in climate change, if you read our paper posted there, we need to have a variety of distribution. The majority will be the government spending, of course, but we really need to put the money out there to solve our problems. And if we just look at the government to get it out, we're going to be too slow. And you can see how slow it is to come out even in emergencies. So that's all I have to say. I mean, the solutions, we have the solutions in the monetary reform movement. We just have to politically get it passed. That's all.
Thanks, Mark. Lucille, do you have a comment?
Yeah, I just wanted to acknowledge and thank Ronnie for, I believe, accepting our invitation to be on our new forming advisory board for the Alliance for Just Money. So that is just information, and Ronnie is one of the 4 or 5 who have agreed to be on it. So thank you for that, Ronnie. And
okay, sure.
Yeah.
Happy to do it. I've enjoyed it.
I didn't realize you had accepted it already. So again, we're about down to 2 minutes. So Dr. Ronnie Phillips, I would like to say thank you for giving us your time this evening and impressing us with your wealth of knowledge on the history of money and everything in banking. So with that being said, there were plenty of things in the chat. This will get posted at some point in time by one of our managers here. I'm not sure if Tabitha or Ryan is going to do it, but it will be online and we'll move on from there. I'm not sure. Do we know when the next coffee house is? I do not have that information in front of me. If not, you will get a notification and we'll send it out. But with that, without any other comments, I'd like to have everybody have a great evening, a wonderful weekend, and hopefully we will see you guys soon. So with that, take care, everyone.
Okay, thank you. Bye-bye.
Thanks, Ronnie. Thank you.
Okay.